Welcome back. It's part three, Mr. Money Maxwell's Guide to Selling Covered Calls. Managing a covered call is simple if you sold it right in the first place. That's why it's so important that we have a system. This is not financial advice. This is for educational purposes only. Make your own financial decisions. I am not a professional financial advisor. Today's part three, we're going to cover managing our covered calls. If you missed part one, if you missed part two, check them out. They're on the main channel. Make sure you subscribe to the channel for new videos. If you missed the first two parts, check them out. So my goal for you today is by the end of this video, I want you to know exactly what to do after you've sold a covered call. Whether it expires worthless, it moves against you, or you even get assigned. We're going to stop guessing. We're going to start managing our trades with confidence. So every covered call we sell is part of a repeatable system. We're going to talk about how to make management passive, what to do when the trade goes against you, when shares get called away, what's next. Stick around to the end of the video. You'll see my best strategy for buying low. Today's all about selling high. Stick around to the end of the video. And why does a system beat emotions every single time? You've already done the hard part. And that's setting up the covered call. That's actually putting it on. Now, luckily for you, I made you this checklist. So that means that you sold into strength, you picked the right strike prices, and you collected a solid premium because you followed the 10 items on this checklist. If you don't have the checklist and you want a copy, head over to mrmoneymaxwell.com/income. Sign up for the email. You'll get this checklist right here. Opt in for the emails. It takes a couple of minutes for you to get the email, but you'll get the email with the checklist. There are three things that can happen to a stock before expiration. The stock can trade sideways. It can go down. Both of these scenarios are good when we sell a covered call. In this example on Starbucks, I'm showing you an April 125 covered call. So as long as the stock goes sideways or down, in terms of the covered call itself and management, this is good for us because our only risk is this red part above 125. It sounds a little bit weird, but when you sell a covered call, you actually want it to stay below or go down in terms of your covered call being profitable. The third option is that the stock can go up. And this is our biggest risk of a covered call is that we are obligated to sell our shares at 125. So if it goes to 130, we're going to miss out on that $5 of share appreciation. That is the biggest risk of a covered call. And for me, it's not a risk because we used a checklist to get in. So hopefully there will be a reversal, but we're just agreeing to sell our shares higher. I like to buy low, sell high. I don't know about you. That's my style. So covered calls allow me to do just that. It allows me to sell high. But there's only three things that can happen to the stock price: sideways, down, or up. Sideways to down is good for our covered call. Up to 125 is fine, but we don't want it to go above 125. If it does, we are obligated to sell our shares. If there is a dividend, like Starbucks had a dividend here, you can get assigned before the expiration date. On the ex-dividend date, they can sell your shares, and the person who bought that call will take the dividend away from you. So that is a risk outside of the expiration date. It really only happens if you are pretty deep in the money. There are really only two outcomes with a covered call, or any option for that matter. Either the covered call is going to expire out of the money, meaning it's worthless, there's no intrinsic value, or your covered call is going to expire in the money, meaning there is extrinsic value, meaning that the buyer of that option wants to exercise it because it is in their favor. When a covered call expires out of the money, it means that the stock stays below the strike price at expiration and you can sell another covered call. Now, this is the ideal scenario because you collected the rent and you get to keep the shares. Now, the second outcome of the covered call is that if it's in the money, the stock closed above the strike price at expiration, so you get to keep the premium, but you're obligated to sell your shares to the buyer of that call because there's extrinsic value. It makes more sense for them to take the shares. So you got paid rent and you sold your shares higher. It means it's time for you to buy low again. Now, I'm going to talk about 3 simple steps for managing all of my covered calls. This is my exact system, and I know if it works for me, it will work for you. The first thing we're going to do is we're going to set a GTC order at 50% of the premium received. A good till canceled order, GTC, means that when the option premium drops by 50%, the trade's going to automatically close because the broker is watching it for us. So we can immediately rent out our shares and we can do it again with another covered call. We're going to set an alert for our strike price. Remember, as the stock goes up, our risk is to the upside. So if we set an alert on our charts for the strike price, that means we have an order for the profits, we have an order for the risky side, meaning we're obligated to sell our shares. The only thing left for us to do is to decide, do we want to take assignment, meaning sell our shares, or do we want to roll them out in time? Now, if the stock is above the strike price at expiration, we'll look at those 2 options. We'll decide which one is better for us. I'll talk about some of the decision-making process as we go along, but that's really it. It's 3 simple steps. There's no stress. There's no guessing. We're just following the system. The first thing we do is we set up profit targets to automate our wins. Now, remember, we win on a covered call when the stock goes down. We're actually wanting the stock to pull back a little bit or at least stay below our strike price. I know it sounds weird, but as option sellers, that is what makes a covered call profitable. So what we do is we set up a good until canceled order. We go out and let the broker sit and watch our profit target while we go and enjoy life. Let's talk about an example. If we sold the call for $1, meaning we collected 100 real dollars, we would set a GTC order for half of that. So I'm paying them back $50 and I'm keeping $50 so I can look for another covered call to sell. It's letting us rent out our shares again faster. It's reducing our call spaces and it's compounding our cash flow because the more times we sell this call over and over again, the more money we collect. That's why I close out calls for 50% of the premium received because I'm looking to do this over and over again. This is the math-based best approach. We're locking in our profits earlier, we're freeing up our obligation, and we're keeping the cash flow moving. Every time we successfully close out a covered call by buying it back for $50, we're reducing our effective cost basis by 50 cents in this example. So if you can do this enough times, your shares essentially become free. If you could sell covered calls on the same stock for 5 years, there's a very good chance, depending on the share price, that the effective cost basis of your shares would be extremely low. Now, I'm not going to dive into the mechanics of placing the order. We've already covered all that, and your broker has videos walking you through it, but here's how simple it is. In Tasty Trade, you just click on the option and you select close at 50%. Tasty Trade does the math for you. Thinkorswim, you have to go to the trade tab, you'll click on create a closing order and you'll buy back the covered call. This is Google. You can see here, here's the trade price of $1. This was exactly like the example I just showed you. So we would set this up to buy it back for $50. Collect 100, buy it back for 50. Once this is set, you don't have to watch the trade. The broker is going to close this for you when it hits the target. It's going to free you up to sell another covered call, keep collecting the premium. But the best thing is you don't have to sit and watch the charts because you know your profit target's going to hit when it's time. Now, the second step to this process, we talked about the profit side. So when the stock goes down, we do good. Our risk is actually to the upside. That's where we're obligated to sell our shares. So what I do and what I'm encouraging you to do is set an alert. So if the stock moves towards your strike price, you have the choice. You can let it expire, you can roll it out and up, or you can buy it back for a loss. Now, I don't want anyone to buy back their covered call for a loss. And the reason we don't do that is because when we set it up and when we sold it, we knew ahead of time, I'm obligated to sell my shares here. And we went through the checklist, so we know that we're in a good situation to sell high. So essentially for today, we're going to look at letting it expire, worthless. That's the best case scenario. And we're going to roll it out and up. If the stock stays below our strike price, we don't need to do anything. Our GTC order is already waiting for us. But what if the stock moves towards our strike price? In this example on Google, I have the 185 covered call. It's marked here on the chart. I right click in TradingView and I set an alert for 185. That way I don't have to look at the chart. I know right away that when I get an alert in TradingView, it says check Google 185, I know that I need to look at my covered call. Now, if you don't use TradingView, your broker will allow you to set alerts as well. So the second part of our management process is to set an alert for the strike price. So we're notified when we are at risk of our obligation to sell our shares. This is how I make it passive. This way I don't have to constantly check on my chart, check on my shares. Just like a landlord, I don't have to check on the tenants every day. I get the notification. That's when I look at the trade and I decide what's my next move. There's no stress, there's no babysitting. I'm just following the system. A GTC order on the profit side, an alert on the trade is going against me side, and then I make my decisions. Now we have to decide when that alert in TradingView goes off, or when that alert in your broker goes off and it says, hey, Google's at 185. We have to decide, are we going to let the covered call expire in the money and sell our shares? Or are we going to roll that covered call to collect more premium? Do you remember from part 1 where I talked about extrinsic and intrinsic value? If we roll our covered call out in time, we're benefiting from the extrinsic value. As we roll out in time, we get paid. Option 1 is we're going to keep our premium and we're going to agree to sell our shares high at the strike price. If you still like the stock, you can sell a put and you can start the wheel strategy. We'll talk about that very shortly. This is the easiest, most hands-off approach. If the covered call expires in the money, you let your shares go and you look to recycle the capital and get into another trade. You can also choose to extend the trade to a later expiration, sometimes even for a higher strike, because you benefit from the extrinsic value. Depending on the IVR, which we talked about in week 2, you might be able to roll from the 185 cover call to the 190 cover call and still get a credit. This is going to keep you in the stock while generating more cash flow. Only roll out if you can get a decent enough credit. Remember the 1% rule from our checklist. I want 1% of the strike price for every 30 days. That goes the same way for rolling a covered call. When we talk about rolling an option, what we're essentially doing is we're closing the current trade that we're in and we're opening a newer trade for a bigger credit than the debit required to close our trade. Even if you roll in your broker, they're closing your existing trade and they're opening a new one. It's called rolling because we're continuing to keep the trade on, but it's actually closing the existing trade and opening a new one. Now, I don't want anyone to panic when they decide, oh my gosh, my alert went off, I'm getting tested. Let's talk about when you should roll out your cover call. And the most important thing is I want you to follow a system. Don't panic. When you start trading from emotion, you start losing money. I made this table. You roll a cover call when you still want to own the stock, when you know you can collect enough premium, remember the 1% rule. And if the stock is near a key resistance or a moving average, and you think there's a chance that it's going to roll back over, roll it out in time and see if the stock is going to roll over. If it keeps going up, then you just don't roll it for the next expiration. You need to have a reason to wait. Don't just roll it because you want to be right. If the stock is taking off and you're $10 deep in the money, meaning you're losing out on $1,000 of share appreciation, just let the stock go and find a different underlying. There are so many stocks out there. You don't have to be right. You don't have to panic and you don't have to let your ego take over. I don't roll when I want to just keep the trade alive. If the premium's not there, I'm not rolling. If the stock is breaking out and I'm $1,000 down on my share appreciation, I'm just going to admit I was wrong and I'm going to either look for another trade or look for a different way to get back in that same stock. Rolling is all about strategy. It's not about panicking. We're going to use alerts. We're going to check our technicals and we're going to make sure we're getting paid enough money to wait. I like to think of assignment as a profitable exit. I don't want you to think of getting assigned as a loss. It's the next step in our system because you collected premium, so you collected rent, you made cash flow, your shares appreciated, so you're selling high, and you got a clean exit. It's time to reset. It's time to do it again. So what's next? What happens when you get assigned? You either deploy your capital in a brand new trade, or you're going to sell a put on the stock and you're going to start the wheel strategy. The wheel strategy is where you sell puts to put the shares at a lower price. If you took the put selling mini course, you know we got paid to buy our shares lower. We get put the shares, we're going to agree to get paid to sell our shares higher by selling the covered calls that we talked about in week 1 and 2 of this course. Losing shares isn't a loss. Stop telling me you're losing. It's just the next step in our system. And if you haven't taken my put selling mini course, you should head over to mrmoneymaxwell.com/action. I'm literally giving you my best content for free. There's no catches, there's no sales pitches. It's just my strategy for getting paid to buy stocks low so I can come over here and start selling covered calls once I get put the shares. Scan the QR code, head over to mrmoneymaxwell.com/action. Take the put selling mini course. It's just 4 weeks, very valuable content. I know you'll enjoy it. So there's really only 3 things you need to do when you're managing a covered call. You're going to set the GTC order for 50% of the premium received. That means the stock either went sideways or it went down, which is good. You reduced your cost basis. You no longer have the obligation to sell your shares, and you can look to sell another covered call. You're going to set that alert at the strike price on the chart so you can make the decision, do I get called away onto the next trade, or am I going to roll it out in time? Because covered calls, we're not going to make this a guessing game. We're going to make them a system. This is how we learn to run our trading like a business. Having a system is great, but having traders to bounce ideas off of is even better. That's why we created Good Kids Trading. It's a free community, traders just like you who are interested in math-based options trading, passive strategies that are super simple. Join our free Discord. I'm posting 95% of all of my trades for free, not so much so you can follow me. I want you to see what I'm doing in the current market environment so you can start building your own plans for trading. Head over to goodkidstrading.com. It's totally free. I will see you there. So that's it. That is the 3-part covered call mini course. If you haven't signed up for the checklist, well, head over to mrmoneymaxwell.com/income. You will get an email from me. I read all the messages. If you have questions about covered calls, if I didn't cover something that is a burning question for you, feel free to reach out to me anytime. You can hit the comments. Make sure you like and subscribe to the YouTube channel. I will see you next time. Let's turn this knowledge into wealth.